The US dollar continues to advance steadily as traders focus their attention to a key risk event. Hello and welcome back to our channel. My name is Daniela Hathorn. And in today's video, we are going to be reviewing the US dollar because, as I said, it's been recovering nicely, continuing its strong momentum and seeing a strong bullish push higher. And there have been a few factors affecting this. But before we get into this video, please like, comment, subscribe, and turn on your notifications. So as I said, the US dollar has continued to recover nicely. It has been pushing stronger for the last month and a half, 2 months. We have seen that bullish momentum continue, a few attempted reversals along the way, but nonetheless, that just alludes to the healthiness of this bullish push. Now, we have seen a lot of momentum in recent weeks on the back of a little bit of a safe haven demand, and that comes from the worsening sentiment coming out of China. This has been supporting the US dollar, as I said, some safe haven demand. And the best way to evidence this is not only the US dollar has picked up some momentum in the last few days, but also the likes of gold and silver. And the Japanese yen is also holding quite nicely against the US dollar despite the strength. So this evidences a bit of a risk-off sentiment in the market going towards those safe havens. Of course, the US dollar seeing the most of this traction because of other factors affecting it. But one thing to take into account is that safe haven demand that has been increasing. We've also had some strong data out from the US. Last week, we saw strong retail sales to finish the week. And that, of course, has been helping as well. CPI coming in, rising a little bit in July as expected, but still evidencing that the fight against inflation is not linear and is not perfect. That alludes to the possibility of a stronger and more hawkish Federal Reserve down the line. And of course, that has kept the US dollar supported as well, with US yields picking up some momentum in recent weeks too. Something else to watch out for is the data we've seen in Europe this morning. On Wednesday, we've seen the PMIs coming out for a lot of European countries. The situation has been quite dire with the data. If you're looking at the UK, all 3 PMIs coming in below expectations in the contraction zone. We've also had some weak readings in 2 of the PMIs from the Eurozone. We've had from Germany as well. The US also expected to report today. But that weak PMI scenario and data also alluding to a little bit of a safe haven support in the dollar. It also evidences that, as we know, central banks, which include the Bank of England and the European Central Bank, are very data-driven at the moment, very data-dependent. And this weakening in sentiment in PMIs just shows a little bit of a spanner in the works for these central banks attempting to remain strong in their policy to combat inflation. So that has been helping the US dollar as well this morning. But one of the biggest events this week, and something that traders likely have their eye on, is the Jackson Hole Symposium taking place now at the end of the week. Jerome Powell is expected to deliver a speech on Friday, and there's going to be a lot of focus on this. Usually the Jackson Hole Symposium is a great place to get insight into the future of monetary policy. And if we wind back to this time last year, we did say kind of Jerome Powell committing to do whatever it takes to combat inflation. So we know the inflation picture back then was a lot more dire than it is right now. Inflation came down to 3% in June, picked up slightly in July, but still close to that upper bound of the inflation target, hoping to get it close to 2% in the next few months. That is going to be the tricky part. The end tail of the disinflation process or the deflation process is going to be the hardest part of it. But Jerome Powell's speech on Friday is going to be very important. Now, he's likely to want to avoid speculation about future rates. Markets are currently pricing in a very small chance of another 25 basis point hike at the meeting in September. And of course, I think Jerome Powell's going to try to avoid too much speculation as to whether there is going to be a rate hike or not. And I think a lot of the focus, and especially the scrutiny in his speech, is going to be on holding rates and how long they're going to be held for. Markets are expecting a cut to come at some point in 2024. We know the Fed has pushed back on this a few times. And we know the Fed wants to avoid making the same mistake that they made in the 1970s when they kind of changed their monetary policy stance too early, became too lenient, and that meant that inflation shot up once again. They want to avoid that. As I said, the data in July is evidence that it's not a clear downward trend with inflation, and therefore it's very much likely that the Federal Reserve and Jerome Powell is going to focus on this uptick in the data in July to justify the need to remain strong and to keep their eyes focused on making sure that inflation doesn't tick up in the near future, which could cause further problems to the economy. So it looks like at the moment, a lot of focus is going to be on that. To be honest, the scenario and situation that Jerome Powell finds himself in is quite good. We've got a strong jobs market with declining inflation. So all in all, on paper, it seems like a pretty healthy economy. And therefore, it's going to give Jerome Powell a little bit more wiggle room this year in his speech. But as I said, focus a lot on how long rates are going to be held. And I think he's going to try to avoid too much speculation on if there's going to be another rate hike or not. Because regardless of whether there is another rate hike or not, with already having seen 500 basis points of tightening, you can really adapt and change the last rate hike with holding rates for longer or cutting them sooner. So I don't think there's that much importance on the terminal rate anymore, but how long that rate is going to be held for. Let's jump onto the chart now and we'll look at some key US dollar pairs. Okay, so here we have it. We're on TradingView looking at some of the key US dollar pairs. I want to start off, of course, with the US dollar index first to get a general grasp of how the US dollar has been performing. Now, we have pushed above the 103 mark, which has been a significant area of resistance in the past, as you can see. And the most evident key area of resistance up ahead, if we're looking at the chart, is of course this area that we touched upon back here in May. The highest there being around the 104 region, 104.15. We saw a lot of resistance along the way. As you can see, those candlesticks really showing that the momentum was coming off during the session, finding a lot of resistance to push higher. In looking at the way the pattern has been folding these candlesticks, we have seen a clear higher high and higher low pattern for a while. We've seen a little bit of sideways consolidation at the end of last week. Again, that's normal after such a strong push throughout the beginning of the week. A little bit of consolidation there, giving traders a reason to push even further this week. So far today, we've got that higher high and higher low already. So looking like this bullish pattern is going to continue, nearing now close to that area of resistance, just around that 104 area. If that area does get cleared, the most evident next area of resistance is going to be just around that 105.50 area, which we saw back in March this year, and also here in January. So there are a few areas of resistance up ahead, but it's very, very clear from this chart that the path of least resistance for the US dollar is going to be higher. The RSI has started to push into overbought territory, as you can see. Now, last time we were around these areas was back here in May when we saw that resistance. So it could start to suggest that the strength in the rally could diminish. We could see potentially a little bit of a retest of a reversal before finding some further momentum. But even so, I think even if we do see a little bit of a reversal in the short term, the momentum continues to be firmly to the upside here for the US dollar. Taking a look at the pound cable, as you can see here, a strong sell-off so far today. As I've said, we have seen some pretty dire PMI data in the UK. We know the Bank of England being very, very data dependent and reluctant to hike in the past. So, of course, this could be influencing traders' thought process right now. What does this mean for the upcoming meeting? Forecasts are for a hike for sure. So far, most of the momentum or most of the probability placed on 25, but of course, 50 not completely off the table, given the situation the UK economy finds itself in. But a lot of weakness here in the pound today. We're now trending and hovering around that 100-day simple moving average, this red line here, just around 126.35, 126.40. So far, potentially finding a little bit of support. It's also the lower bound of the Bollinger Bands. And you can see the Bollinger Bands had started to tighten, essentially squeezing the moving average here. So it really shows that volatility could be increasing. So far today, that is the case. this squeezing of the midline suggesting, as I said, that volatility will pick up. So I wouldn't be surprised if the bands start to expand from here, giving a little bit more wiggle room for sellers to take hold, potentially pushing below key resistance here at around 126.15, looking to break further, potentially all the way back to the 61.8 Fibonacci level here, just around that 124.50 area. Elsewhere, if we look at euro dollar, again, seeing some weakness in this pair as is normal, tracking quite nicely the momentum in the dollar for the last month and a half, as we know. The euro dollar being one of the biggest weights in the dollar index. It's pretty normal that we see a very close comparison here, finding potentially a little bit of support here just along that 200-day simple moving average, 107.98 at the moment. This is currently almost where we're tracking. So just hovering around the 108, again, another significant psychological area. We may see some support arise there. But the path of least resistance looks to be to the downside here. The RSI also nearing that oversold region here. Of course, the flip side to what we're seeing in the dollar index. Again, last time we were around these levels was back here in May, similar to the dollar index. So I wouldn't be surprised, as I said earlier, to potentially see a little bit of a test around this level. For this pair, it would be potentially looking to reverse higher. But again, even if that does happen, I think there is little momentum here to continue to push higher. So as I said, path of least resistance looks to be to the downside. That is it for today's review on the US dollar, looking ahead at the Jackson Hole Symposium. Thank you so much for watching, and don't forget to subscribe to our channel.